So you say you've been declined for a mortgage? Well, maybe now you just might qualify. There's some changes on the horizon. Stay tuned. Hello everybody, my name is Barry Horvath and this is Moving Forward TV with your local market update.
And I am DeLynn Gaston. Thank you so much for joining us today. So we definitely have some changes on the horizon as far as some of the guidelines for Fannie Mae, Freddie Mac. Well, Freddie Mac is not quite up to speed on some of the changes, but I do want to say, you know, once COVID started almost 2 years ago, year and a half ago now, a lot of overlays.
It's been 5 years since COVID started, DeLynn.
It feels it, you know, but a lot of mortgage changes, right? Everybody remembers that. All of a sudden, a whole bunch of new guidelines were kind of, they called them overlays, you know, extra steps, extra things that had to happen. Recently, they've removed a lot of those extra steps and extra things that we had to do. Fannie Mae and Freddie Mac and FHA and VA and USDA, all the programs, everybody
and
removed.
MOUSE.
Everybody removed some of the changes and the overlays due to COVID. However.
Wait, there's more.
Wait, there's more.
I'll tell you what's not changed.
What?
The Rays, the Tampa Bay Rays, have made the playoffs 3 consecutive years. So that's what people really want to know about in
Yay.
the community. So,
okay, that would be the sports show.
Oh, this is the wrong show? Okay.
This is the mortgage.
All right,
I know
all right.
mine is boring compared to sports shows.
People love to hear about things that are positive.
You're right.
Actually, the changes going on in the mortgage industry are positive. So for those of you who may not have qualified before or were on the edge, we have some interesting updates that can really make a difference. So
yes,
in a nutshell, I mean, and we're going to talk about that, but I think before we get into it, we have a little video clip here that we're going to chime in with us to show us that. Is that okay?
Yes, but before we go to the video clip, we have to explain kind of what it's about.
Yes.
So the video clip is going to talk about DU. So DU, so
What
that
is
you guys
DU,
know,
DeLynn?
desktop underwriting is what it stands for, and that is Fannie Mae. So as many of you realtor partners out there already know, when a loan comes in, the first thing we have to do is we have to run it through the automated underwriting system, AUS, mortgage.
Blah,
You know,
blah,
the mortgage,
blah, 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 blah.
the mortgage industry is really big on initials. So they run it through the AUS, automated underwriting system. DU is Fannie Mae, LP is Freddie Mac. So this is all having to do with DU. Freddie Mac has not made these changes yet. This is strictly Fannie Mae changes. So when you hear them referring in the video to DU, it is desktop underwriting. It is Fannie Mae's changes that go to the automated system.
And it's very important for them to know, because when people are getting pre-approved.
Exactly.
And
That's why we're saying
yeah,
this.
some lenders don't go through that extra step, you know, when you have a borrower that's maybe on edge of being pre-approved or not, but they can actually take the borrower, run it through the automated underwriting, which is an electronic underwriting, and get an approval for you in these systems. And all it does is really, in layman's terms, it takes all of the borrower's data, all their information, their job history, their assets, their credit scores, all these different things, puts it in this electronic system. We feed it in, poof, it spits it back out, and it says yay or nay. And that's it in a nutshell, right? I mean,
and then
really.
we tweak it and try to get more yays than nays, obviously.
Well,
and this is going to enhance that. And these are all positive things that are changing.
Yeah, I agree. So let's take a look at what these changes are, and then we're going to explain them to you as we go.
Hello and welcome to this Radian Timely Topics video. Effective September 18th, Fannie Mae will be implementing several new guideline and desktop underwriter DU changes that will have a direct impact on many of the loans you will review. In this short Timely Topics video, we will highlight some significant changes, including the addition of positive rent payment history, updates to credit score eligibility for specific loans, as well as updates to the URLA that can be found in DU. Let's start with the positive rent payment history, as this change may positively impact many potential borrowers. Effective the weekend of September 18th, DU will attempt to verify consistent recurring rental payments within the verification of asset or VOA report. This review will then be used as part of DU's credit risk assessment. This change may help borrowers qualify for loans that they may not have previously qualified for. If DU is able to identify the rental payment history with a pattern of consistent payments from the borrower's bank account data, the system will use this as a supplement to the overall credit risk assessment. The use of positive rental payment history does not require any special exception or approval. However, it must meet specific loan criteria to be utilized for qualification. The borrower must be a first-time home buyer, and the mortgage transaction must be a purchase of a primary residence. The borrower must have been renting for at least 12 months. The borrower's rental payments must be at least $300 per month. The borrower or borrowers must have a credit score, and the lender must obtain a VOA report with 12 months of bank statement data through an authorized DU validation service asset verification report vendor. Additionally, in order to ensure DU is able to identify the rental payments, the lender must enter the monthly rent paid by the borrower in the DU loan application, order a 12-month VOA report and enter the corresponding reference ID in the DU loan application, and confirm the borrower is the account holder and that the account from which the borrower pays rent is included in the VOA report. Lastly, as you might expect, DU will provide specific messaging that you need to be aware of. This will be in the form of 3 messages. Rent payment history is used, an asset report is obtained but not used and why it was not used, or an asset report was not obtained but the use of a report with rent payment history could positively impact the recommendation. While there are several conditions that must be met, this could be a great opportunity for your borrowers. For additional information, be sure to check out Fannie Mae's DU version 11.0 September update document linked below this video. Next, we will outline the new credit score eligibility. Fannie Mae has determined that this change could have a positive impact on many potential borrowers who may not have qualified before. The borrower's credit score does not generally have a great impact on the DU decision unless the score is below 620. Effective September 18th, if the primary borrower has a score below 620, they may still receive an approve eligible if the co-borrower has a FICO that brings the median average to a score at 620 or greater. As a lender, you do not need to do anything to implement this change. DU will handle the review by determining the middle score of each borrower, or lower of 2 when only 2 are received, and will then average the middle scores to determine if the loan qualifies. Considerations that should be noted include, this only applies to multi-borrower loans, and this will not create a lower score for qualification. This is currently not eligible for refi now loans. Let's review a quick example to help you understand this better. Borrower 1 has a 595 middle credit score, and Borrower 2 has a 667 middle score. For this example, DU will take the 2 middle scores of 595 plus 667 and determine the average of these scores, which would be 631. If the loan was previously declined due to a low score, it may now receive a potential approve eligible. For the Uniform Residential Loan Application, or URLA, we will see
This is, to me, the credit score changes.
Yes.
Because now we have, I want you to think about the example they just showed here. Mr. Borrower, great credit, Mrs. but no income.
Right.
Mrs. Borrower
has all the income.
all the income, lousy credit.
Right.
Now we can blend the two of them together to help them qualify.
Yes.
We could never do that. Most people don't understand. Why
And-
can't we use my income? Well, your credit score
And that's
sucks.
what I was just going to say. So what we've been doing in the past up until now is we would take whoever has the lower credit score, take them off the loan, and try and do it just in the person who has the higher credit score. And sometimes that creates high
and
debt
then some
ratios.
people get mad and
because
leave you.
I know.
'Cause you
But
can't
this
count
is-
their
And
income.
this is the way it was. And so everybody has 3 credit scores, Equifax, TransUnion, and Experian. So we use, borrower 1's middle score, borrower 2's middle score. And out of those 2, they always use the lower of the 2. That was the way it's been done for years now. That's how it's been being done. So if the lower of the 2 is that, 602 or something like that, that was knocking them out of qualifying for the loan altogether. So we had to take that borrower off. But now what they're saying is we're going to be able to blend those, which is nice. Now I do want to point out, this is not going to affect how the loans are priced, though, which is also based on credit score. This is merely for qualifying purposes.
Yeah, so here's what we don't know yet. Does that mean normally we use the lower borrower credit score, the lowest middle score of the 2 borrowers? So if the lowest score is a 560, how is
Right.
that going to price out? That
So,
we don't know yet.
and that we're going to have to find out because
And this is all new.
yeah, it's all
all
new,
new.
and that all has to do with the secondary market and what mortgage-backed securities and such, and what Wall Street is buying, so to
Right.
speak. What kind of they want to see.
And of course,
We certainly don't want to get into where they were just
I
back in
know.
the crazy days.
Yeah, well, you know what? The Fed, the government, actually has been buying mortgage-backed securities now since 2009. What does that mean to consumers? Low rates.
Low
It really
rates.
does.
That's why they've
what's
been low.
keeping the rates down. As long as the government is pumping money into that bond market, it's going to sustain low rates. They don't do it. If you remember, they were doing that quantitative stuff where they were
Yes.
back when the market was crashing.
Yeah.
That was keeping us afloat
Right.
during that time. Now they're easing it in at different times, and we
Right.
don't know when. So,
But
hey,
they're
it's a
still
great.
buying,
It's
and
still a
that's
great
good.
time to buy. But the rental portion of this, you as a consumer don't need to really do anything. Just know that if you have an on-time rental history, we go in and we actually can count that as a positive to help you qualify for the loan. So just keep that in
Because
mind.
basically, when we run the AUS, the DU, and such, it's Fannie Mae is looking at everything, the entire application as a whole. It's not just looking at a credit score. It's not just looking at your job history. It's not just looking at your income.
I love that
It's
you
looking
say
at
that.
everything.
I love that you say that because people go, my credit's a 700.
I know.
I should
Oh, I
get a
should
loan.
be able to get a- yeah.
I can
Well-
get a $500,000 loan because my credit's good.
Yes.
No,
It's a
you
number
can't.
of-
You haven't been on the job for long. You keep changing jobs. You've had a foreclosure 2 years ago that you didn't tell us about. Whatever, blah, 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 blah. You have IRS payments that we don't know
Right.
about. There's all these
So
things.
now rental history is now going to be a part
Sorry,
of the mix.
did I sound
which in
negative
a-
there? I didn't mean to.
You did, in a
All right,
positive
let's get back to the
way.
Rays. The Rays are in the playoffs.
All right. Now, the other thing that we feel this is going to help out with is obviously the other thing that's kind of popular out there right now is the down payment assistance programs.
Yes, it
so,
is.
But I do want to say, so the mortgage insurance, the PMI companies, they are absolutely aligning with Fannie Mae and doing the exact same thing. They are also going to be doing the average of the credit scores for approval on your PMI. However, the down payment assistance programs, the county and the state, we're still kind of waiting to hear on those. The jury is still out on those. They have not decided just yet. We will keep you posted when they do, if they're going to align. Because as you know, the state program has a minimum credit score requirement of a 640. And I don't believe they're jumping on the bandwagon with Fannie Mae at this point, but we will let you know.
But if
for
you don't
sure.
like it, wait a minute, because
I know.
our industry constantly changes. That's why we bring you timely information every single week. So it's important you watch it. So let's talk about the down payment assistance programs.
While we're on it.
While we're on it, because there's been a lot of activity on it. I mean, let's face it. The number of first-time home buyers moving into the market right now because of rents are going up every time. If you are a renter right now, you know that likely, especially if you're in an apartment, every year they're going to raise your rent. You know, when you buy a home, you are locking in for a fixed payment per se. Now, taxes and insurance can change, and you are going to have the cost of home ownership, but you are locking into a payment for the next 30 years potentially. So, you know, just that peace of mind alone and stability should be a reason why you should
That
own
you're
a
not
home.
going to get kicked out,
Yeah,
right?
and people are like, oh, prices are high, I'll wait. Well, the cost of waiting is crazy because, you know, I remember the year before last, people were like, oh, the market's too hot, I'm going to wait. And then, you know, here we are again, 2 years later, the market's even hotter. There are no signs of this market easing up. Will it level out? Yes, we believe it's going to level out.
And it has started to. We've definitely seen some leveling.
But there's still a high demand for housing, and we're still going to see appreciation. You know what? I always tell my clients this. You don't make money on real estate by making your mortgage payment. You make your payments to keep your home.
Right.
And because I know this, and you all know this, you look at your mortgage statement, this much goes to principal and this much goes to interest, right? Where do you make money on real estate? In the long term, you make it by appreciation or depreciation, you can lose, of course, of the housing market. And the longer you're in your home, the greater the possibility for that appreciation to occur. People who bought houses, I mean, my first house was $35,500. Okay, it was in Regency Park. It was $35,500. It was a modest 2-bedroom, 1-bath. Do you know what that house is selling for today?
What?
Probably about $220 to $240.
Isn't that something?
Okay, and mind you, you know, again, if you paid down a $30,000 mortgage, whoopee, right? But that appreciation every year.
There you go.
Think of it this way. When we see a 17% appreciation in the market, in the housing market, you've just made 17,000 or 17% on whatever that home value is worth. I mean, mind you, you got to cash in to do it, but at some point you are going to, you're creating
It still
wealth.
is one of the best investments people can make. Real
So,
estate is still one of the best investments you can make.
Long term, absolutely.
The thing with the rental, you know, with the people who are out there renting right now, one of the things that I always like to bring up as well, like you said, you know, you don't have to worry about getting kicked out. So we,
No.
you know, we
know people let that happen.
We know somebody that they've been renting the same place for over 10 years, and now because this market is so hot, the seller.
He wants to cash in.
He wants to cash in.
I want to be
He wants to sell
done.
the house. Well, that person is not in a position to purchase the home. So after 10 years of living there, this person has to move out of the house. So
Yep.
that's a little scary. So when you own your own home, that's not going to happen to you either.
Yep. You know, so these down payment assistance programs are very popular for first-time home buyers. They can really help you out if you don't have the money to qualify. Now, mind you, I know it's a seller's market out there, and I know that sellers are being, you know, picky.
Please
on
educate your sellers.
on
Please.
people they're allowing to buy their house. They want the cream of the crop, conventional buyer with the most down or the cash buyers. I get that. But you know what? There are people that are getting these houses with down payment assistance. They're out there. You just got to be patient. You may have to put multiple offers in. You know, you might be utilizing our quick qual system, which we can do a whole show on that, to generate your pre-approvals. But these down payment assistance programs are out there. And while they're not for everybody, they do have a fit. So if you have no money saved up, you might want to look into these programs. I mean, we can get $5,000 to $15,000 of money to help you purchase your home and lock
these are
in that
not-
rent payment.
And these are
Per
good
se.
buyers. These are good borrowers. These are definitely good buyers. It's not like it's a problem. These people have to qualify for the down payment assistance as well. So these are good people.
So what are you seeing
don't
right
knock
now
them
in
out.
the programs? Can we give them a Reader's Digest version
Of the programs. So you have your state program has $7,500 available to $10,000 available. In most cases, that's kind of where most people fall in those two categories. And the county program has either $5,000 or $15,000 available, depending. And actually, they even have $25,000
Yeah,
available.
we saw one of
for
those.
we saw one of those as well. So each program definitely has its own quirks and limitations on it. So just give us a call. We're doing quite a few of these right now. So
Yeah,
so
don't
we're
be
pretty
afraid
well
of
versed
it.
in what's going on.
And I know the realtors get frustrated. with certain buyers. They're like, oh, I'm not going to deal with them because they don't have no money.
I know.
You know what? Everybody deserves a chance to buy a home. And I think those people seem to be the most grateful at the end of the day.
They are so grateful.
A lot of
I have
them
one
work hard.
closing today, and I'm just so excited for her. She's a single mom, and she has been trying for so long to buy a house, and she literally cried when I told her that she was approved, and
Yeah.
it was moving forward. And
Yeah,
we're closing
you gotta
today.
love it.
I know.
Isn't that why we do what we do? All the aggravation, all the grief.
Yes,
Some days,
that's it
this
right
industry
there.
is
So
not
I'm
easy.
so excited about that.
So
closing
down
today.
payment assistance is big.
And it's good.
And it's
Don't
good.
say no
It's
to
good.
it when
All
you
right.
see a contract come
Let's
through.
talk about the other sector people are moving to because the cost of housing is going up.
So what happens when the cost of housing is going up? And some people, it's just getting out of reach for them, right? They just can't afford a house.
People buy manufactured housing. What?
Manufactured homes. That's
What?
where it's going.
What? You're buying a manufactured home? What, are you crazy? That's what I tell them. But no, there's some good opportunities out there. I mean,
They're very well priced right now, and they're becoming more and more popular because, again, and it's all in one. People have always liked them anyway. So manufactured home, also known as mobile homes, same thing. So people sometimes think there's a difference. No, there's not.
if you can put wheels on it and move it,
And if
it
it had
walks
a
like
VIN
a duck.
number at one time, which they all did, it's a mobile home.
Yeah.
So, but there are definitely, you as our realtors out there, and even as the buyers out there, we want you to know there's definitely some things. So first of all, give your lender a little bit more time on these. If this is a finance transaction that you're buying, because there's definitely some extra hoops and extra hurdles that we have to jump over that don't come with normal houses, but come with manufactured homes. Engineering reports, and try and help us and get these things up front if you haven't. If you're listing one, if you're a listing agent and you're listing one of these homes, ask your seller for the engineering report. Chances are they had to get it too when they first bought the home. So we need an engineering report, and we also need the data plates. So there's 2 data plates on all of them. And this is, keep in mind, some people think, oh, that's only for FHA. No. That's
for everybody.
Conventional is actually almost more strict on that. Every loan program. So we need data plates. There's 2 data plates on every one of them. One of them is on the outside, and one of them is generally on the inside of the kitchen cabinets. And when I say data plate, I do not mean a metal plate on the inside of your kitchen cabinets. It is a piece of paper, but it's got all of the information that is necessary that the appraiser is going to look for. Now, being appraisals are taking longer these days, I don't want to wait until the appraiser does it. If you guys can give me a heads up if that data plate is there or not, and if it's not, we have a workaround, but that workaround,
it takes time.
it takes 10 to 14 days. So
Yep, it
the
takes
sooner
time.
we know, we got to work on a team on these, like a well-oiled machine. We really have to work together on these to make sure it moves along as quickly as possible.
Those data plates, if you want to compare, when you get your car fixed, what's the first thing they do when they go to the shop?
They look at that little thing in your door,
They
right?
open the car door, they look at that label that the
perfect.
manufacturer put on it. It's the same thing on your car as your manufactured housing.
Yes.
And hopefully someone didn't change the cabinets and peel that label out. And it
That
happens.
has happened so that's why I'm bringing that
Or
up.
they paint,
That has happened so often
yeah.
lately, so often. And the other thing, just so that people are understanding as well, manufactured homes definitely cost a little bit more because that letter that we're talking about, if
the
they
closing
changed,
costs you're referring to.
yes, closing
Yeah.
costs. If that label is removed, those we have a workaround,
Yep.
but it takes 10 to 14 days and it's expensive.
Yes.
The other thing is engineering reports are not cheap. And what the engineering report does, because people say, well, why would it need an engineering report? Anything that was added after the house was put on the property and after it was put on the foundation and tied down and everything. That means if they added a carport, if they added a screened enclosure, if they added a patio, if they added porch, if they added a deck, if they added anything to that house after it was placed on that property, we're going to need an engineering report. And again, this is not us. This is the industry-wide. This is Fannie Mae,
We don't make
Freddie
up
Mac,
the rules.
FHA, VA.
We just follow them.
We don't make the rules. Exactly.
No,
That's what I tell people all the time. I don't make them up.
the rules. I don't make. I can't
just
make this
follow
up.
'em.
And you know what's funny? People call you and they don't like what you tell them, but you tell them the truth.
I know.
So someone else might not tell them the truth, and then they go through all this stuff. I like to tell people, hey,
I tell them right up front.
here's what you're going to need. Here's how it's going to work. So,
And I tell them, this is not me, this
Yep.
is everyone.
Yeah.
So hopefully they're not going to, because I don't want them going to somebody else and getting led down this rosy path and then getting the
it's
rug
not
pulled out from
rosy.
underneath them
You're
at the end.
borrowing money, a lot of money. It's not a rosy path.
And we all follow the same rules
Yep.
and regulations and
Just-
guidelines.
Yep.
We do not vary on those guidelines from lender to lender. Very little, very little. Someone who can't do it, someone else probably is not going to be able to do it either. They might vary a little bit with their closing costs. They might vary a little bit with
Yep.
their interest rates. But for the most part, guidelines are guidelines. Some are
rules.
stricter than others. I don't know. I tell people right up front, this is not me. This is the whole industry. This is a Fannie Mae thing. This is a Freddie Mac thing. This is an FHA thing. Doesn't make a difference which lender you go to.
So bottom line, manufactured housing is on the rise. Just allow that
It
little
is.
extra time that you might need. The title company will also need a little extra time because there's different reports that they also have to do,
Exactly.
especially for those who had one mobile home on the property at one point that was removed and no one ever fixed it on title because they tie to each other.
Sounds like you're talking about what
What
might have happened.
Yeah, it can happen. So
Yes.
there's all kinds of things. You know what? There's things that can go wrong in every transaction. You just got to be prepared and know.
Exactly.
We learn from doing this so long
Right.
of what can go wrong. And it's almost like, don't we look at people today, we look at them through this little scope, right? And we're like, okay, what can go wrong? This is too perfect. You know?
I know. I know. So on the other end of the spectrum, do you want to touch real quick?
You know what? Jumbos are on the rise too. We need to do a whole nother show on it. We don't have time this week, but there are ways to do jumbos and avoid jumbos because the guidelines are a little harder by doing a combination first and second.
Talk about a tease, huh?
Yeah, so, and we can help you with those transactions. And we'll cover more of that. But you know what? Let's wrap up, but let's tell them about WPBA right now. What's going on? So our charity of choice, West Pasco Business Association, is still, we're trying to still make an impact in the community as we always do, always will. Bowling for Boobs has moved to a more virtual status.
Right.
Unfortunately, with COVID, we have to not bring all these people together, and it's unfortunate. We don't know what's going to happen to the Grinch, but here's the good news. We still have money to help people with rental assistance. So if you know anybody that needs help with rent and utilities, been affected by COVID, go on WPBA.biz. That was just our website that was flashed up. Go under the HEART program. We have funds that maybe we can help you. So go to WPBA.biz.
And it's easy. It's easy to apply. It's easy to go on there.
You must qualify. You got to live in Pasco County. Happy
Right.
to help you get some of these funds that are available. So.
And if you're a landlord, talk to your renters, about
might be
this.
struggling.
Maybe they're behind, or maybe they just need some help. Maybe they're paying you late. So just have that conversation with them. Hey, there might be help for you. There might be help for both of us. So
Yep.
by all
So
means.
anyway, thanks everybody. I think a lot of information this week. Hopefully
know.
we didn't
Did we,
bombard
like,
you, but
cram it
hopefully
in
you
too
learned
fast?
a little bit.
Just
So
call us if you want further information.
don't forget to like our show, share it.
We appreciate everybody watching We Are Today and Every Day.
Moving forward, have a great week.
See you next week.